Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. I've talked about a lot of different areas on this show, and I'll continue to do that pertaining to your finances and your life planning, actually, and all the different financial implications of your decisions and how it can affect your life positively or negatively. Well, what we're finding is good decisions lead to better results, which leads to happier lives in some cases. And what we try to do in the financial planning world is help you take advantage of some of the opportunities, some of the tools and resources, and some of the products that are available. So today I wanted to talk about some of the different tax qualified products and strategies that are available by the IRS to help you either grow your money better or more efficiently, or take your money out better, positioning it through IRAs and 401ks, things like that. Even for college, if we have time, I'll get to that. So let me start right in. Everybody probably is very familiar with the 401k and the IRA world. What I want to share with you is, even with an IRA, these IRAs, people think of as generic, just a regular traditional IRA. These can be used as special vehicles and in some cases actually be pulled from tax-free. So what happens in a traditional IRA is a person who has earned income. You have to be working to make contributions to an IRA. A person who has earned income takes a portion of whatever they have received out of their pay. Let's say at the end of the year, or even up to April of the following year, when you're filing your taxes, you may choose, or your accountant may tell you, make a contribution to an IRA, we need to lower your taxes. So you'll say, well, I don't understand how that works. Well, in reality, the way it works is, if you're in the 15% tax bracket, 20% tax bracket, 10% tax bracket, it doesn't matter. If you have $1,000 of otherwise money that you've received and it's in your checking account already, you already cashed all your paychecks, and you have $1,000 left over at the end of the year, and you want to invest it. And the accountant says, listen, I want you to contribute to an IRA. They're not giving you investment advice. They're just simply giving you tax advice. And they're saying if you do, let's say you're in the 15% tax bracket, if you use that $1,000 and go to a financial institution and open a traditional IRA and give them the $1,000 for it, you will be able to, on your tax return, show that you made a $1,000 contribution to a traditional IRA. And what that does is avoid tax, or in this case, you list $1,000 on your tax return that you made a deductible contribution, and that $1,000 is deducted from your income. And that means that just saved you or made you $150 if you're in the 15% tax bracket. Well, folks, listen, $5,500 is the maximum this year unless you're 50 or older, age 50 or older, and then you're able to go another $1,000. So you could do $6,500 contribution in an IRA. And you know, if you're in the 15% bracket, that might be $1,000 that you get back on your tax return. So it's big money we're talking about here. And that's why some of the accountants are giving tax advice, not investment advice, to contribute to a tax deductible IRA. Even if you're with an employer plan on a 401k, I get asked the question, can we still contribute to an IRA? And based on parameters that are listed in the IRS code you're able to deduct for an IRA in addition to having contributions in a 401k if you meet the qualifications. So let's say you do that and you say, well, wait a minute, what's the catch? Well, the catch is that you have to play by the playbook. And the playbook on IRAs, on deductible IRAs, which are called traditional IRAs, you get the tax deduction up front for every contribution. All of the earnings every year as that account grows, grow without showing up on the tax return because you are in what we call a tax qualified vehicle. So everything's sheltered in there like a bubble. So all the gains, if you're buying and selling whatever you have inside there, which would normally be taxable every time you sell or have tax consequences if you had a loss, all of that is sheltered and tax deferred. I say tax deferred and not tax free because the day comes where you have to pay the piper, and that day is, with the traditional IRA world, whenever you pull the money out. So it can be the next year or it can be age 90. But there are rules that if you pull it out in the next year, that you're going to get penalized if you're under the age of 59 and a half for pulling it out prematurely. And that penalty is an additional 10% tax on the amount that you pulled out prior to age 59 and a half, plus all of the income tax on whatever you pulled out. So all of the gains, the reimbursement of your principal. Let's say you put $1,000 in and 2 years later you cashed it out and there was $1,300 in the account. You would immediately be penalized $130 on the whole amount if you closed the account out, and you would be taxed on the whole $1,300. Because remember, even the amount you put in was really never taxed because you got your tax back on that. So you might be in a 15 or 20% bracket by then, but let's say 15, you have $1,300, and you say, well, that might be almost $200 I lose on that, or so for the income tax plus $130. So it might be about $330, let's say, for example. You might only get $1,000 and you had a $1,350 IRA. So cashing it out prematurely is usually a no-no. There are special circumstances, emergency circumstances, where you can avoid the penalty, but you cannot avoid the tax. All right, let's take the normal now. Normal age, at least age 59 and a half, you avoid the penalty, but you'll never avoid the tax. Now, don't forget, in the beginning of the show, I said sometimes be able to pull out of an IRA tax-free, and I'll share that with you in just a minute. So the basic rules, you don't touch an IRA until you're age 59 and a half or later is the goal. And I'll share this as an aside. All of you who have annuities that are not IRAs, they follow the same rules. Be very careful with those. So if somebody says to you, here's an annuity, it's only a 5-year term or a 10-year term, and then you can get out of it and do whatever you want. Hey, folks, be careful. I know it's not an IRA. It could be, but in this example, let's say it's a non-qualified tax-deferred annuity, and you invest in that for 5 years or 10 years, and then after you're out of the surrender penalty period and you're free to walk away, when you walk away from an annuity, they have the same rules for premature distributions being taxable and penalized as IRAs. In other words, you're subject to the 59 and a half rule. Most people don't think about that. Most people don't know that. Many advisors don't know that. So when you enter the annuity world, you're getting trapped or trapping that money into the annuity world unless you're willing to pay taxes along the way and pay that penalty. So here's where it becomes important on the annuity front. It's a tax-deferred annuity, which means you did not get a deduction for the original contribution. The initial contribution, it will come back to you without being taxed. So you're not taxed again. If you put $10,000 into a tax-deferred annuity, it's a non-qualified, so not an IRA, as opposed to if you put $10,000 into an IRA annuity, which you couldn't do because you'd exceed the annual maximum, but you could roll over into it, let's say, from another IRA, just as an example. But I'm talking about the non-qualified right now. You have a non-qualified annuity, you put $10,000 into it, you wait your 5 years or 10 years, it does as you expected it to do. The account balance is $14,000, and you pull it out and you're age 45. There is a 10% premature withdrawal excise tax penalty by the IRS, but only on the gains. So it's not on the whole amount, it's on the 4,000 gains. Because you pulled out prematurely, which by IRS code for annuities, they say they're designed as retirement vehicles, even if they're non-qualified, you pay penalty and you pay ordinary income tax. So don't forget the annuity world. When we talk about the IRA world, a lot of the rules and restrictions still apply. Most people have never heard that, actually. So I thought I'd share that as I just thought about it. Okay, back to the IRAs. You're over age 59 and a half. You pull your money out. It is all taxable, but only in the amount that you pulled out. So after age 59 and a half or 62 or 65, it's not taxable until you pull it out. But let's say you start taking income, $500 a month. You're over age 59 and a half. There's no penalty, folks. So most people say, oh, breathe a sigh of relief, take the check, don't withhold any taxes because we said there's no penalty. Hey, folks, I said no penalty, not no taxes. So you still have to withhold your 10 or 15 or 20% for your income taxes, okay? Now, let's say, remember, this thing grows tax deferred. So all the year's gains stay in this account. They're not taxed, they don't show up on your tax return. So year after year, this thing keeps growing and growing, let's say. You say, I want to grow this thing forever. I don't want to take it out. So you're age 59 and a half, you don't care. 65, you don't care. You never want that money out of there. You like that growing tax deferred. The other sources of income are adequate. Let's say, for example, well, the IRS says, oh no, after you turn the age of something, you're going to have to start pulling out of the IRA. We have to get some tax at some point. They're designed as retirement vehicles, but the IRS says if you don't take out by a certain point, we're going to force you to start taking out so we could start getting tax because you're abusing the IRA. Okay, fine. So their code, the IRS code says at the age of 70 and a half, you have to start taking out of the IRA. The technical rule is basically the year following the year you turn 70 and a half. You have to make your first withdrawal. And then you have to take a required minimum distribution every year following that year you turn 70 and a half. So even if you wait until the year following and follow the law precisely, the year following the year you turn 70 and a half is the year you have to make your first distribution. However, and that's by April of that year, by the way, but however, by December 31st of that very same year, the year following the year you turn 70 and a half, you're 71 and a half. And by December, you have to take another one. So you have 2 in 1 year if you squeeze that rule. So our general advice sometimes is talk with your tax advisor and see if it's advantageous in that very first year where you have the flexibility. Should you take your first required minimum distribution in the year you turn age 70 and a half or in the year following the year you turn 70 and a half, even though you would have 2 years worth of distributions by the end of that year? Talk to your tax advisors, folks. So now we get to the point of my mystery question. Okay, Jack, but you keep saying there are some cases you can put into an IRA tax-deductible contribution, get all your taxes back on that income, have it grow tax-deferred for life, or almost life, and then at some point, under certain circumstances, be able to pull it out and have it be tax-free too? Well, the IRS law says it's fully taxable, but here's how sometimes it can work where the IRA distributions are also tax-free. And here's one of them. Let's say you're a senior. Let's say you have low income. Let's say you are only taking $12,000 or $15,000 income. You know, if you go to a tax preparer, sometimes you will run into a tax preparer in older years that says, you don't have to file income taxes anymore. Your income's low enough that you don't owe any taxes. And whatever you pay, you're going to get back at the end of the year anyway. And whatever withholding is taken out of your pension or your interest checks, you just get back at the end of the year anyway. The IRS does not require you to file taxes if every year you don't owe taxes. We as tax preparers say, be careful with that one, because if anyone is withholding for taxes out of any income checks that you have, like pensions or Social Security, if any, or even interest from any accounts, if they're withholding, you have to file a tax return just to get the money back. So what you have to do is, if you want to stop filing income taxes and you're qualified, your accountant tells you you qualify to no longer pay file income taxes because you never owe, make sure you don't have any withholding automatically deducted along the way. But here's where it gets interesting. You ask your tax preparer, let's say you have an IRA, and even with your required minimum distributions, you still don't owe taxes, or whatever they withhold for taxes, you're getting back at the end of the year. If the tax preparer discovers that, and they're on top of things, we look for this. We do tax preparation in our office. We look for opportunities, just like I'm about to explain. Many tax preparers are unaware of it or don't look for it or too busy to look for it. But because we're financial planners and doing the taxes, we're looking for opportunities. And one of them is this. Let's say you could actually have $5,000 more this year in what would be taxable income, and you still wouldn't owe taxes. So you could earn up to a certain amount before you start owing taxes. So our question is always, what amount? And how far are we away from it? How far below it are we? And if we took money or earned money, we could still earn another $5,000 or $6,000 before we would start being taxed. And we look at it, and let's say in this example the answer is yes. Here's the key. We then say, why don't you take, and you're over age 59 and a half, why don't you take an extra $5,000 or $6,000 withdrawal from your IRA? And the client says, I don't want to pay tax on that. I don't need that money. And we say, no. You can earn an extra $5,000 or $6,000 because of your deductions and your income threshold before you'll owe any tax anyway. Let's get it out of the IRA tax-free and just set it aside in another account growing in the exact same company where it was with the IRA. So you're placing your money exactly the same way, however you had it before. But it's outside the IRA now. That can happen in a tax loss year, a low income year. There are lots of reasons. High medical deductions, expenses, where we're looking for opportunities to say, boy, we wish you had more income because you wouldn't owe any tax on it. We're creating more taxable income by being able to pull out of what would otherwise be a fully taxable IRA. And get this, even if you're under age 59 and a half, there are circumstances sometimes where medical bills are so high or you're out of work or whatever and you have an IRA, you can even, the way the penalty works, you will be subject, if you're under age 59 and a half, to the premature withdrawal penalty if you pull out of an IRA, right? We just talked about that. So if you pull out of a tax-deductible or traditional IRA, not only the amount you pull out is fully taxable, but also you'll be 10% penalty. You know what? As long as the amount of the income and the penalty don't exceed, in this example, the extra $5,000 or $6,000 you could have earned. You take the amount of the penalty that would now be taxed because that's how it's assessed as a tax. And that tax on the income or distribution out of the IRA, as long as all of that doesn't total up to more income than $5,000 or $6,000 in that example for this mystery person that I'm giving you an example on, you get back the excise penalty and the tax. A lot of people don't know that one either. Folks, to try to do this yourself, I say this on every show, to try to do this yourself, why would you try to do this yourself? You're not typically dealing with this day in and day out, 8 and 10 and 12 hours a day, to become a skilled and high-level professional at making the best financial decisions that you can make. So you'll say, well, it costs too much money to have the financial advice. And I did hear a saying, and it's true, if you think education or hiring professionals is expensive, try ignorance, which means not having access to the professionals or getting the education yourself. You can get the education yourself. It only takes about 38 years. By my experience, 39 now. That's all it takes. It's easy. So you can choose your path. But my goal is for those of you who say, I'd rather spend my time golfing, visiting with the grandchildren, traveling, doing other hobbies, spending time with my family and the kids, hire a professional and will help you make much better financial decisions than you'll make on your own. And look at how valuable that might be. All right, folks, we're out of time today. I appreciate your tuning in. I'll be back next week with another edition of All Things Financial.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.